Let's bring in Chris Hyzy of Merrill and Bank of America Private Bank. Good to see you, Chris. Welcome back.
You too, Scott, as always.
With a headline like that, it sounds to me like, given our conversations that I recall having, you're more positive on the market than you've been in at least the last 12 months.
Yeah, I think it's important to put it into context. The positivity is really coming what is in store for the back half of 24. You've been covering a little bit of this recently, which is the market looks forward 6 to 9 months, sometimes a little bit longer than that. Next year's story, I don't want to get ahead of it here, but next year's story is about a drop in yields. We can't see it right now, but with what we're seeing in the slow growth trends, there's some strains out there well covered coming out of China for sure. And then in the United States, what we're starting to see is a little bit of drag from the positive real yields, which hasn't been discussed enough, going from negative real yields to positive real yields with a wide gap. Negative leading indicators. There's a lot of things piling up right now where headline risk, and you were talking about this before, is very high. But if you go back to profits, we don't need a big expansion for profits to ultimately bottom out, most likely towards the end of this year, and then start to show the signs that we're going to begin to recover. August is an Auburn month. It's leaving the brown days, the hot days of summer, going into the October leaf-changing days of red. You put the two together, it's an Auburn-type month, consolidation, technical factors, structural factors, low volume.
But you're suggestive that we should be buying stocks now then. I mean, if we have the ability to look ahead 6 to 9 months and an improving profits picture, that today is the time to even take advantage of some of this, unsettled nature of the market and put some money to work.
Yeah, we all have been saying a variety of different things as relates to choppiness, edginess. That's been the telltale sign every time something doesn't go your way. In August, this pullback, seasonably the case, we would use this as the first episode. We think there's going to be 2 more after August and into the early part of September, one towards the end of this year, and then in spring of next year. Once you hit that nadir, that topping out of yields before the Federal Reserve starts to say, hey, wait a minute now, we might have to start to pivot a little bit sooner than the market believes. So we think there's 3 episodes of weakness. There's a lot of cash on the sidelines, and certainly there is a slower growth environment coming. But you have to have plans ready right now. Most people are still under their benchmark, Scott, in terms of their exposure to equities. And if you're long-term, when I say long-term, you just have to think about into later 24, into 25, and the market should start to adjust your way in a positive way. So dollar cost averaging, starting now, makes sense to us.
But you also made the case, of, if I heard you correctly, that you think there could be 2 more bouts of selling periods before the real opportunities present themselves. In terms of the current one, which we may be in to some degree, we're down today and we've been down, the last couple of weeks have been unsettled. How much of a correction do you think we're in store for now?
Typically when you get slow volume months like August, 3 to 5% makes sense to us. I don't see any much more than that. If it comes a little bit more than that, it's a bigger opportunity. The big Magnificent 7, if you want to call it the Grade 8, whatever it may be, they push the market's valuation up. In our opinion, justifiably so, because if you're going to see slower growth, you do migrate towards those areas that are going to give you the growth. The story early and late 22 was those Magnificent 7 areas, the big mega tech, were slowing down in their revenue growth. And what they showed us was, yes, they slowed down, but they didn't go down as much as expected. This was a relative move. Now, next year, it should be more of an absolute move. So from our perspective, everybody likes to wait. They want to catch a bottom. Market timing doesn't work. It's time in the market and rebalancing when the market activity gives you the opportunity to do it.